These types of extreme readings we've seen in overbought levels are indicative of bull markets and not bear markets.
Well, we just passed $3 trillion of stimulus to rebuild America.
The yield story for us is probably the biggest risk.
You look at the run-up that we had from April directly into earnings season, and then the reaction basically being sell the news. Like, I'm okay with that outcome. I don't think stocks should rally 20%, then report the earnings that everyone was excited about, and then rally another 10%. It's unnecessary. If you look at August generally, and then even August based on the presidential cycle in the third year, which is where we are in 2023, this is all very standard. This kind of action. So that's where I am on it. As far as the China stuff, China's been an economy in slowdown for most of the last 10 years. They've effectively had a lost decade in their stock market. And I know they're doing some new stimulus stuff. It doesn't seem to be enough. People aren't that excited about it. The reopening was underwhelming. I was never investing in anything based on like a blockbuster Chinese economy. So I'm definitely not going to sell on that either.
When China sort of sniffles, everybody else gets a cold. The reopen's been a sputter at best, and the markets, for the most part, brushed it off. They unexpectedly cut rates. The slowdown appears real. How much does it matter?
The good news is that they are stimulating, or they're trying to. It's just a little bit less than what we thought, but it's kind of like slowly trickling every week or so. I don't think the entire economy is slow. We did hear good things from Nike, Starbucks, both from Wynn and Las Vegas Sands. Numbers are good, right? So there are pockets of China that I would be investing in. On the reopening side, I think there are two pockets of industrials that are seeing a lot of momentum. Aerospace, aviation, and then it's reshoring. It's not so much Caterpillar. It's not so much Deere. They've had nice runs for sure, but they do have more exposure in China. The U.S. economy is really doing well. The Atlanta Fed GDP now for this current quarter in the U.S. is at 5%. It wasn't supposed to happen like that, right? I think on the manufacturing side, we are bottoming, Scott. I do. I think the PMIs are bottoming. Even the Empire Fed number today, which I know headline was ugly, but the forward-looking indicators were actually quite strong. So I think you are bottoming. And again, go back to onshore, reshore, whatever. That's a big theme. And that's a big part of why I think we have held in terms of the momentum. And why is that so important? Well, we just passed $3 trillion of stimulus to rebuild America. And that's very powerful. And so despite the fact that we've seen higher interest rates, it's this other side that's kind of offsetting it. And it's really pretty encouraging. Unit labor costs actually fell, and yet productivity went higher. That is actually bullish for GDP as well. And then retail sales today being much better than expected. That too is a function of a better GDP. And you put it all together, and that's why we got a 5% number today.
The yield story for us is probably the biggest risk. You get to that 420 level based on two things. Either inflation isn't cooperating or growth is cooperating. And it's a growth story, Morgan. So that's very, very different from where we were when you said test the October highs. Last October, we were between 6 and 8% on inflation. People worried about inflation back then. Now it's a story of, okay, now it's almost impossible to get 2 consecutive quarters of negative GDP growth with jobs pulling back this year. The recession is off the table. One more thing. I don't think the Fed really has any need for the 10-year Treasury to fall because of the housing market. They really need a 7.25% mortgage rate because the last thing that they need is a reignition of something like owner's equivalent rent that can create just another bad story on inflation. I think that's the story. But again, this is a high-class problem because of the growth story. It's very, very different from where we were last year when inflation was still between 6 and 8%.
The biggest issue, I think, for the market in the short term here is the increase in interest rates. We're in the month of August, historically weak period of year. Towards the end of July, investors started to get offsides. We saw what was some extreme readings in overall market strength. The NASDAQ 100, 25% above its 200-day moving average. The S&P 500 overbought since Memorial Day. The NASDAQ overbought since Cinco de Mayo. 5-month winning streaks for the S&P 500 and the NASDAQ. So these are all factors that led some investors maybe to believe that the market could only go higher here. And coupled with the weak seasonality, I think investors getting a little bit of a reality check, which is good for the market overall. Longer term, though, what you have to remember is these types of extreme readings we've seen in overbought levels are indicative of bull markets and not bear markets. And so I think from a long-term perspective, you see a short-term pullback, which is healthy here. And as I said last time, we don't know where the market is going to be in the short term, but we're pretty confident that it's going to be higher by the end of the year, and we still feel that way now.